Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, New York City, we have Zehrid Osmani. He is the head of global long-term constrained investing over at Currie. It's a Legg Mason Company. We're going to take a look at the areas you need to be investing in within the electronic vehicle market. It's great to have you with us, Zed, at market site. And electric vehicles really continue to gain share around the world.
Absolutely, yeah. It's a very exciting investment opportunity. If you think about it, as investors, it's not often in the history of financial markets that you have an established market, the car market that's taken more than 100 years to establish itself, that's effectively mandated to migrate from combustion engine to electric vehicle by regulators, by governments, at the same time as consumer taste is also shifting from that combustion vehicles to electric vehicles.
All right, let's pull up our first chart here and we can see just how the production numbers are really moving higher as you get into 2030.
That's right. So basically, this is our proprietary market estimates to 2030. And what you can see is the overall market model isn't growing too fast, but electric vehicle take-up is very rapid. So what you've got in a market that's quite pedestrian growth, you've got the electric vehicle units that we're forecasting to be growing at 30% annualized to 2030. That's a pretty explosive growth potential.
Okay, let's take a look at our next chart here, and so we'll take a look at the value chain analysis and what the different components are you want to be investing in to arrive to the final product of electric vehicles.
That's right. So this is basically highlighting our overall approach of looking across the whole ecosystem when we look at an investment opportunity, because it's important to be looking at the whole value chain and to look at where is the most attractive value creation in terms of positive ROIC over WACC spread, which is a definition of value creation for us as investors. And usually we find that being right at the forefront of the consumer, which is where the car manufacturers are, is pretty risky for investors. If you think about it, that effectively exposes your investment opportunity to consumer choice risk. And we don't want to have to make a call on whether one car manufacturer is going to be able to sell more cars than another. Consumer tastes do change over time, and that's not going to make us sleep well at night. Further up the value chain, we can find some opportunities in companies that provide services to any of the car brands, no matter which is. So it makes us being able to sleep better at night because we don't have to make a call on whether Tesla or GM or Ford is going to be the one that sells more car to the consumer.
All right, and some of the areas that you're looking at here, we'll go down the line, batteries, and we put our chart back up there. We'll take a look at some of the different components that go into it, starting with batteries, grid and infrastructure, technology, of course, because cars are basically a traveling living room at this point, and the lighter weight materials.
That's right. So again, if you take the principle of looking at where the high returns opportunities are, you look at batteries, battery manufacturers. That's a segment where the ROICs are in the region of 9 to 11%. So somewhat attractive, but not overly attractive. Grid and infrastructure and everything that goes into charging stations, smart grid, and so on. There, the ROICs are not great. You're looking at 5 to 6% ROIC max. If you look into the lightweight materials, there are some companies that are generating ROICs in the low teens, so there might be some attraction there. But if you look at the technology and connectivity, that's where we find the most attractive investment opportunities. You've got a range of companies that typically will generate ROICs in the region of 15 to 25%. So when you zoom out, that's where you can see that the value creation is the highest as defined by high ROIC companies. If you zoom further up at the car manufacturers, top down globally, the auto segment only generates a ROIC in the region of 6%. So that's not great. And back to the point about being at the forefront of the consumer, you've got very aggressive pricing pressure in that segment. It's very competitive. There are many discounts on cars, increasingly more so. And the other aspect is that more and more car manufacturers are coming up with their version of electric vehicles. So it's going to be an increasingly more crowded segment.
Right, so in addition to looking at the value chain, you have your attractive return on invested capital. Of course, you have the pricing power that you don't have to worry about, such as the car manufacturers, but it's also a high barrier to entry. You're not going to have as much competition as you might have up top.
Precisely. And I like the words you're using. Barriers to entry is what we always like, because by definition, that gives you pricing power. We also try and find companies that are so-called mission critical. A mission critical company for us is a company that might be a very small component of the overall cost of a car, but where the product that they provide to the car manufacturers is critical to the well-functioning of that car. that by definition gives you even more pricing power.
All right, Zed, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.